We are discussing the topic of valuation in this video. First of all, to discuss the terminology of valuation, we need to know what is value, what is price, and what is cost. We should know difference of these three terminology before understanding the definition of valuation. What is value? Value is basically the worth or utility you fetch from any commodity. And what is cost? Cost is actual cost of construction in context of quantity surveying. And what is price? Price is basically actual cost of construction plus profit plus interest you have incurred on that cost. Okay, so these are three different terminologies. Then we will come down to next terminology, that is valuation. Valuation is the technique of estimation or determining the fair price or value of property such as building, a factory, other engineering structures of various types, land, etc. By valuation, the present value of property is defined. The present value of property may be decided by its selling price or income or rent it may fetch. Value of property depends on its structure, its life, maintenance, its location, bank interest, etc. So basically, whenever we are finding out value of one property, we are finding out its present worth, and it is stated at a given time. It depends on various factors, but before that we will discuss the next slide, that is purpose of valuation. Valuation is used for buying or selling of property. It is required when you buy or sell a property. To know the exact price, we do the valuation. Second is Second purpose of valuation is taxation. To assess the tax of property, its valuation is required. Taxes may be municipal tax, wealth tax, property tax, etc. All taxes are fixed on the valuation of the property. Third is rent fixation. In order to determine the rent of a property, valuation is required. Rent is usually fixed on certain percentage of valuation, that is 6 to 10% of valuation. Then valuation is required for security of loan or mortgage. Whenever we are taking loan from some financial institution, we need to mortgage our property. So in that case, valuation is needed. Then in case of compulsory acquisition, whenever government department acquires property for some purpose, they need to pay some compensation to the owner. To determine the compensation, valuation of property is required. Also, valuation is required for insurance purpose. Then we will discuss the next terms, that is gross income. Gross income is the total income and it includes all receipts from various sources, the outgoings, the operational and collection charges are not deducted. Then next is net income. This is saving or amount left after deducting all outgoings, operational and collection expenses from the gross income or total receipt. Then next terminology is sinking fund. A certain amount of gross rent is set aside annually as sinking fund to accumulate the total cost of construction when the life of building is over. This annual sinking fund is also taken as outgoings. Then we will discuss the next two important terminologies. One is scrap value and second is salvage value. These are various types of value we are going to discuss. Scrap value is the value of dismantled material. Whenever you are demolishing some building, whatever left after demolition is called as scrap value. That means we get after demolition we what we'll get, we will get steel, we'll get bricks, timber, steel. In case of machines, the scrap value is metal or dismantled parts. In general, the scrap value is about 10% of the total cost of construction. Scrap value equal to sale of usable material minus cost of dismantling or removal of rubbish material. Then second terminology is salvage value. It is the value of utility period without being dismantled. We can sell it as a second hand handle. So basically, if the building's life is over, then without dismantling, whatever value we can fetch is called as salvage value.
Market value of the property is the property obtained at a particular time from open market if the property is put for sale. The market value will differ from time to time according to demand and supply. Basically, in market value, there are two parties, buyer and seller. They negotiate with each other for the particular property and they decide the appropriate price. After negotiation, the transaction is done. This value changes from time to time for various reasons such as change in industry, change in fashion, means of transport, cost of material and labor, etc. Book value is the amount shown in the books of account after necessary depreciation. Book value of the property at a particular year is the original cost minus the amount of depreciation per year. The end of utility period of the property, the book value will be only scrap value. So book value is the value which is shown in the books of account, whereas market value is the true value which we fetch if we buy or sell the property. Thank you.